Overnight, the U.S. Federal Reserve kept interest rates unchanged, reinforcing its cautious stance despite signs of easing inflation. While markets had largely priced in this decision, attention now shifts to the timing of rate cuts, a move that could have far-reaching implications for emerging markets like the Philippines. Now, how will this impact local borrowing costs, the peso, and investment flows? What strategies should businesses and investors consider in this shifting monetary landscape? Joining us to provide his insights is Dino Aquino, the head of fixed income at Security Bank. Good morning, Dino.
Good morning, Maiki. Thanks for having me again.
Oh, it's good to have you. And things have changed
a lot.
Since that discussion. They've changed a lot since that discussion.
Since our last discussion, yeah.
Just a couple of hours ago, overnight, while we were sleeping, the U.S. Fed decided to keep rates steady in a dovish hold.
Yes, it was a dovish hold.
Yeah, this was also highly expected. What are your initial reactions to this decision?
Well, obviously, if you look at the market reaction, it's pretty much positive. Equity markets were higher, bond yields were lower, but I don't think it changes the overall macro dynamic in the medium term.
The overall macro dynamic for the U.S. and for the Philippines.
Yes, in the medium term. Yeah.
Interesting, you pointed that out. Because, apart from their decision to keep rates steady, they also said that they revised the growth targets lower, which is going to be good for bonds. And that's going to mean more rate cuts.
Okay. They kept their 50 basis points guidance, which they reiterated last year in December.
Yeah. They also said that inflation over the short term poses no risk.
A little bit of risk.
A little bit of risk?
Just in the short term.
Just in the short term.
Yeah.
Okay. In any case, the Fed's decision to keep rates unchanged gives the BSP room to reduce interest rates.
Yes, it does.
So with that decision, does that strengthen your position that the BSP will cut rates this April 10th?
I think they're likely going to reduce policy rates this April. If you go back February 14, I think it's more of the timing. That's why they actually held rates then. I think 18 out of 19 economists expected a cut last Feb 14, right? But the day prior, if you recall that day, the day prior, the inflation print in the US came in higher than expected. And our peso was closing in on the weak side of things. It's around 58.50 to 59. So the BSP took a cautious approach. So they kept rates steady. Fast forward to now. So, for example, the meeting is today. If the meeting is today, definitely they're going to cut. That's what I think, especially after what happened last night.
Okay, there's going to be so much liquidity coming into the system, especially with the cut in the reserve requirement ratio, seen to inject some 320 billion into the system, with another possible rate cut in the second half of the year. In this kind of environment, how much liquidity do you expect to flow into the bond market?
It depends to be seen because there's a lot of liquidity right now, but it's all in the short end. So market is pretty much in the duration fear still. They are still on the safe side of things, so they would like to invest in the treasury bills. So if you look at the bid to cover ratio on the recent treasury bill auctions, it's pretty large. So everyone is loaded with cash, but they just are not yet trickling down the yield curve because of possible uncertainties with regards to the tariffs and uncertainties with regards to Trump and, of course, policy uncertainties.
But bond prices move inversely to interest rates.
Yes.
The 10-year bond is a key benchmark. That's looking like the sweet spot right now. Can you tell us why? And that has changed since our last discussion.
Our last discussion,
it was the shorter term ones that were sweet.
Remember.
And now it's the 10-year ones. What has changed, why, and how can we position ourselves?
Well, in our last discussion, I did specify the belly, which is the 5 to 7 years tenor buckets as a sweet spot for bonds. Fortunately, it actually gained since we last spoke. So yields are lower on that side of the curve by around 10 to 20 basis points. On the other hand, the 10-year is actually higher by around 5 to 10 basis points. So if you look at the yield curve, it actually steepened. So if you ask me, if you look for value in the curve right now, the 10-year gives you the best value given that the yields have actually steepened quite a lot. And we're still expecting rate cuts. So I guess for me, the 10-year is a sweet spot.
Now's the time to buy before the rate cuts come into play.
I agree. Yeah.
Okay. On another front, I wanted to talk to you about the global macro risks. Taking a look at the three figures, the key three figures shaping policy and a lot of direction in the U.S. There's Trump. There's the U.S. Treasury Secretary, Scott Bessent. And there's Elon Musk with the Doge initiative. What are your thoughts on these guys and how they're shaping things for the rest of the world?
If you're an investor coming into 2025, the first person you'll think about is just one guy. it's the Donald, basically. So he's the monkey
wild
wrench.
card, yeah.
Yeah, and of course with him are those two key figures that you mentioned. Of the three, Scott Bessent, I believe, is the adult in the room. But in essence, if you look at all their, of course they tweet a lot. I'm not sure if you read their tweets, but they tweet a lot. They give tariffs, they retract, they say things, they retract. But there's three key things that they actually kept reiterating, and they actually continue to communicate to the market on a weekly basis. One is they want the 10-year yield lower. Two is they want to devalue the dollar. And three is to cut the U.S. spending. And it's all the hallmark of the Doge initiative that Elon Musk is head.
And how do you think that's going to bode for us? How do the thrusts of the Doge initiative, number one, to bring the 10-year yield lower, to devalue the dollar, and to really cut spending, how will that bode for the rest of the world, especially emerging markets like the Philippines?
Secretary Bessent used he used the detox word.
So they're avoiding the word recession.
The R word, yeah, they're avoiding the R word.
It's a bad word, okay.
Yeah, it's a bad word. So he mentioned that we have to shift from government spending to private spending. And in that shift, in order for that to shift, we have to go to an economic detox. So I don't know what he means by that. Does it mean they're going to a recession to actually bring prices down? Or it means it's just laying off a number of workers, because that's one of the key thrusts.
They choose their words so carefully, but at the same time we're left guessing. Okay, on another front, the JP Morgan Asia Bond Index and the Philippines' possible re-inclusion. This is going to be a game changer. It's going to be a game changer. The Philippines is under review for re-entry into the JP Morgan Bond Index. How transformative could this be for the local bond market?
That's a lot of inflows coming in. That's a lot of inflows.
And that's what we need.
That's what we need. So, year to date, in terms of volume, I think the average volume on the bond market's around 30 billion. And maybe half of it is just on treasury bills. So it's quite low, on the low end. So if we get included, that would easily double. So it would attract more foreign investors into the bond markets.
Liquidity was a key issue in 2015 when we were removed from this list. What are the reforms that we need to make sure that doesn't become an issue moving forward?
I think the BTR is in the process of establishing benchmark securities. I've been in the market quite long ago, long ago, 2008. They had these benchmark securities, the 2-year, 3-year, 5-year, 7-year, and 10-year, in where it's called the jumbo bonds. So the liquidity on those bonds are quite large. It's like 700 billion per issue. So those are really, really liquid bonds. So I think the BTR is in the works of doing doing the same thing again in order for the market to be more liquid. Because there's a lot of issues in the market, the bond issuances, but not all of them are liquid. So to improve liquidity, you have to minimize the number of securities that's being issued, and then make the market more liquid by trading less securities with more liquidity. Okay. So that would improve the liquidity moving forward.
All right. Well, unfortunately, that's all the time we have for today. But Dino, thank you so much for sharing your insights on this topic.
Thank you so much also for having me.
All right. On another